Welcome back. Today, we're diving into a crucial topic: how to avoid panic selling in the stock market. Panic selling is a common mistake that can be costly for investors, especially during periods of market volatility. Fear can drive people to make irrational decisions, often leading to selling at a loss just before the market rebounds. In this video, we'll explore ways to stay calm and protect your investments even when the market gets rough. Understanding panic selling. Panic selling happens when investors, gripped by fear, rush to sell off their assets to prevent further losses. This reaction is often triggered by negative news, economic downturns, or unexpected global events that create uncertainty. When many investors start selling simultaneously, it causes sharp drops in asset prices, which further fuels market volatility. This emotional response can easily override logical thinking. Investors might abandon their long-term strategies and sell at a loss, locking in those losses instead of waiting for a possible recovery. Strategies to avoid panic selling in the stock market. Diversify your investments. Diversification is a key risk management strategy that involves spreading your investments across different asset classes, industries, and regions. This approach minimizes the impact of a downturn in any one area on your overall portfolio. Example: instead of investing all your money in tech stocks, allocate some to bonds, real estate, and international markets. This way, if one sector struggles, your entire portfolio isn't as affected. Establish a pre-planned strategy. Having a clear investment strategy in place before market turbulence can help you stay focused on your long-term goals. Set target prices for buying and selling, and define your risk tolerance and investment timeline. Example: create a plan that outlines your financial goals, like saving for retirement. Specify the conditions under which you'll buy or sell, helping you stick to your strategy even when the market gets volatile. Use stop-loss orders. A stop-loss order automatically sells a stock when it hits a predetermined price, limiting your losses. This tool can be particularly helpful during downturns, as it removes the emotional aspect of decision-making. Example: if you own a stock priced at $100, you might set a stop-loss order at $90. If the price drops to $90, the stop-loss triggers a sale, preventing further losses if the price continues to fall. Manage your use of leverage. Leverage can magnify both gains and losses. Using too much leverage during market declines can lead to significant losses. Keeping leverage at a manageable level helps protect your portfolio from excessive risk. Example: if you're using margin to buy stocks, avoid borrowing more than you can afford to lose. High leverage can lead to margin calls, forcing you to sell assets at a loss if the market drops. Take profits periodically. Regularly taking profits can help you lock in gains and reduce the temptation to panic sell during downturns. By securing profits when your investments perform well, you create a buffer against future losses. Example: if a stock reaches your target price, consider selling a portion of your holdings. This allows you to benefit from gains while still maintaining a position in the stock. Know your risk tolerance. Understanding your risk tolerance is crucial in choosing investments that align with your comfort level. When you know how much risk you're willing to take, you're less likely to panic sell during downturns. Example: if you're risk averse, consider investing in more stable assets like bonds or blue chip stocks. These tend to be less volatile than high growth or speculative investments. Stay informed, but don't overreact. Staying informed about market news is important, but it's equally crucial not to overreact to short-term fluctuations. Focus on long-term trends and the fundamentals of your investments rather than reacting to every piece of news. Example: follow reputable financial news sources and keep up with the companies you invest in, but avoid making impulsive decisions based on sensational headlines or short-term market movements. Practice emotional discipline. Emotional discipline means staying calm and rational during market volatility. Techniques like mindfulness and sticking to your investment plan can help you manage fear and anxiety. Example: during a market downturn, take a step back and remind yourself of your long-term goals. Avoid checking your portfolio too often, as frequent monitoring can increase stress and lead to rash decisions. Conclusion: panic selling can seriously harm your investment portfolio, but by understanding what triggers panic selling and applying strategies like diversification, pre-planned investment strategies, and emotional discipline, you can make more rational decisions during volatile times. Remember, the stock market is inherently unpredictable, but with a solid plan, you can navigate its ups and downs and stay on track toward your long-term financial goals.